Welcome. Imagine owning a piece of real estate that is all about fun: ski resorts, water parks, theaters, even schools, and it pays a huge dividend yield of 7.5%. That is exactly what EPR Properties offers. But with all this potential, is it worth adding to your portfolio? In today's video, we'll break down EPR Properties, a unique REIT focused on experiential real estate, and see if its high yield is too good to be true or a rare opportunity in the market right now. Let's dive in. We will start with the fundamentals, then we will move on to financials. After that, we will speculate about the future, and lastly, we will estimate the buying price for the stock. Fundamentals. So what does EPR do? EPR Properties is a real estate investment trust specializing in experiential real estate. Unlike traditional REITs focused on residential or office spaces, EPR invests in properties designed for entertainment, recreation, and education. Their portfolio includes movie theaters, water parks, ski resorts, gaming, and wellness centers, all places where people go for memorable experiences. EPR earns revenue primarily through rental income and long lease term agreements with tenants, which allows them to distribute regular income to shareholders. This focus on experiential real estate offers investors exposure to a niche but growing segment of the real estate market. Financials. Currently, EPR's FFO is $4.85, with a PFFO ratio of only 9.35. They are paying a monthly dividend, yearly $3.42, and with a yield around 7.5%. Their payout ratio is about 70% from their FFO. Short interest is around 3%, with a market cap of $3.5 billion. Total returns for the last 12 months are around 10%, and for the last 5 years, minus 15%. Total returns accounts dividends, and please note that 5 years ago the lockdowns happened. Revenues per share are constantly growing except in times of trouble like the 2008 crash or lockdown a couple years ago. This makes sense considering EPR's business model. As you can see, FFO and AFFO were hit hard when the lockdowns happened. The movie theaters had to be closed and all fun activities were cancelled. Now it's on the path to recovery and somewhat the same levels as before the lockdowns. The debt situation starts to be under control. For REITs, anything under 5.5x net debt to EBITDA is a good level. They also just got a $1 billion revolver loan. Debt maturities are quite short, but as interest rates are going down, I don't see an issue with this. In summary, lockdowns were a serious hit to EPR's financials, but things are getting better for EPR, at least on paper. Future. Based on history, you don't have to be Sherlock Holmes to figure out that recessions and economic downfalls aren't great for EPR's tenants. When tenants suffer, so does EPR's rent collection. Keep in mind that EPR doesn't own the businesses, it just owns the land, structures, buildings, etc. Therefore, EPR's rents are compromised in hard times, but that also means huge profits when or if EPR rises from the ashes. EPR has had 2 crashes in its history, the 2008 financial crash and the sea lockdowns few years ago. It has avoided bankruptcy both times and risen again. Unfortunately, I don't think that good times will last forever, and we will see a new economic crash in the next decade or 2. But this doesn't mean that we cannot make good money and take advantage of this cyclical nature. People are also starting to spend more money on experiences rather than things. and maybe in the next recession EPR has learned from its mistakes and has more bulletproof model. In the end, I still see the short-term future as very positive. Intrinsic value. Let's estimate a buy price for the stock. Forward FFO is now $4.85. Growth is expected to be somewhat slow because they are still in a survival mode, but things are looking better. Analysts are expecting around 3.5% growth. I would estimate around 3% growth for the next 5 years, and after that 2.5% for the next 5 years. And I like a 12% return for my money. EPR's PFFO ratio has been all over the place, but now it's sitting on 9.35, which means a 10% return without any growth, which seems a bit low. I would assume a good conservative PFFO ratio would be around 14 times. With these numbers, we can estimate a buy price for EPR. With our estimations, EPR seems undervalued for 12% return. Here you can also see other prices and returns for EPR. Right now the stock price is hovering around 16% returns per year if our estimations are right. I do own the stock and plan to buy a bit more. EPR is a large stake in my portfolio right now, so I'm not adding too much. Remember to do your own research, and this is not a recommendation to buy the stock. In summary, EPR is a pretty good company that has survived many crashes, has a juicy monthly dividend, has a low valuation, but is still not out of trouble yet. Well, what do you think about EPR? Is it going bankrupt? Are you gonna buy it, live off the dividends, and move to Bali? Comment below. And while you're down there, hit the sub. And as always, do not lose your money and safe travels.